Welcome to the second video of the Study Abroad program. In this video, we're going to talk about the euro, which of course is a major currency for about 20 countries in the European Union. And the idea here is not to really make you an expert because frankly, I don't think I'm an expert, but I'm hoping that by providing this video, I have organized information in a way that you have enough knowledge that when we get to Europe, it's a little bit more interesting for you. You're a little bit more prepared to ask questions and investigate. But again, I'm not trying to make you an expert. I'm just trying to give you a passing knowledge of the euro, its history, how it affects economic growth, how it affects its financial markets, and we're going to end with a bit of a case study with thinking about the Greek financial crisis. Hope you enjoy. Before we dive into specifics of the euro, let's talk about money in general and what needs to happen for money to function properly. Economists effectively believe there are three key criteria that need to be met. The first is that money needs to be a medium of exchange. What that means is that currency needs to be universally accepted in whatever region it's being used. So for example, in the United States, everyone is willing to trade for US dollars. That is clearly our medium of exchange. We could compare that to, say, Bitcoin. Bitcoin has some aspects that make it like money, but it is definitely not a medium of exchange. You know, if I owed my parents money and I offered to pay them with Bitcoin, they would refuse, which means that Bitcoin is not their medium of exchange. So money needs to be universally accepted in whatever area it's being used. The second thing money needs to do is it needs to be a unit of account. This one's a little bit more challenging to understand. But effectively what it means is when you think about the value of something, you think about it in terms of whatever your form of money is. So if I ask you, how much does a cup of coffee cost? Whatever you put that answer in, whatever form of currency you put that money in, that is your form of money. So if I say to you, a cup of coffee is $3, or if I tell you that a Toyota Corolla costs 25 grand, you know what those values are, right? You don't have to think to yourself, what is $25,000? You inherently know what it is, and that's because it is your unit of account. And then the third function of money is it needs to hold its value pretty well. Now, obviously, money typically experiences inflation. If you think about well-run currencies, inflation is actually by design, but it needs to hold its value fairly well so that if I give you $100 today, you understand that that currency is going to have about the same value tomorrow. If money is losing value very quickly, that's hyperinflation, you'll want to get rid of that money. And if you're trying to get rid of that money, that can cause the economic currency to basically become destabilized, right? On the other hand, if money is gaining value, that's also problematic because if money is gaining value, you're incentivized to wait to make purchases. So money needs to hold its value pretty well enough that you're not worried about its changing value on a day-to-day basis. For money to work, all three of these criteria need to be met. If any of them fail, the other ones tend to fail too. And to illustrate that failure, let's imagine a country that's experiencing hyperinflation. Under hyperinflation, obviously that currency becomes a bad store of value. So if we think about the German mark post-World War I, it experienced hyperinflation, so it was a horrible store of value. Also, because it was experiencing hyperinflation, people didn't want that currency. So if you're offering to pay me for a good or a service, I would say, you can't pay me in German marks. And if I'm not willing to accept it, it's no longer a medium of exchange. And finally, the third criteria of money, a unit of account. When money is changing value very quickly, it's hard to know what it's worth. So back during these periods of hyperinflation in Germany, once you got paid, you really didn't know what that currency was worth until you went and bought something with it. And even in grocery stores at the time, when you went up to the counter, you wouldn't know how much something would cost until you went to go pay for it. Money became a very bad unit of account. A million marks, it was hard to know what it was worth on a day-to-day basis. On these criteria, it is very clear that the euro is indeed a form of money and a really well-functioning form of money. It is definitely a medium of exchange. Within the 20 countries that use the euro, everyone is willing to trade for the euro. Even people that aren't in the European financial system are willing to trade for the euro. If somebody offered to pay me in the euro, that's not my primary medium of exchange, but because I know it is so well trusted, I'd probably be willing to accept it. It's also a good unit of account. It holds its value pretty well, and people know of its value through time. So when you're in the Eurozone, you're going to see that prices are quoted in euros, and everyone understands the value of a euro. And of course, it's a good store of value. It has maintained its value fairly well over time, similar to that of the United States dollar. And you can see that here. The blue line there represents the US inflation rates through time based on CPI. The red represents the euro. And you can see that not only are the euro and the US dollars generally experiencing low, relatively stable inflation rates, but they're also kind of connected, which is probably what you would expect to see when you have two well-functioning currencies. They're going to be linked to each other to some extent. So you can see when inflation rates in the US go up, so too do inflation rates in euro in most cases. Let's do a little history lesson here. We want to learn how the euro came to be, why some countries have adopted it and others haven't. And to get us started, let's go back to 1992, the signing of the Maastricht Treaty. The Maastricht Treaty created the European Union, and the European Union has a lot of important factors and factions, and it's one of those things that if you're interested in politics, you should definitely study. But I'm not so interested in the political ramifications of the Maastricht Treaty. I'm more interested in the euro and the financial and economic consequences. But nonetheless, let's talk about it real quickly here. The Maastricht Treaty was created with many goals in mind, a large one being European integration. Those countries that were involved in the treaty, basically felt that it would be advantageous for there to be a European identity or cohesiveness that would help with political connections, maybe reduce conflict, and also help the economies. One of the things in that treaty was the creation of a universal currency. So in 1992, when this was signed, it laid the foundation for what would eventually become the euro. One of the lasting legacies of the Maastricht Treaty is the so-called Maastricht criteria, which was a list of things that countries needed to do to be considered eligible to adopt this potential universal currency. And those are: 1, maintaining low inflation rates; 2, showing that the government is not going to go crazy with borrowing. Specifically, it needs to have a budget deficit that is less than 3% of GDP each year and a government debt to GDP ratio of less than 60%. It needs to not do any like crazy currency manipulation. As we'll talk about here in a bit, some countries will intentionally make their currencies low in value, devalue their currency, and what that does is it makes the currency cheap, so it makes the goods that you buy from that country also cheap. China did this with the United States. They devalued their currency, and so when U.S. citizens were considering buying Chinese goods, since it was so easy to get Chinese currency, it also meant that Chinese goods appeared very cheap. To be considered for the euro, you need to not be doing that as a country. And then finally, there must be low and stable interest rates on 10-year government bonds. Largely, that shows stability because countries that have a lot of risk tend to have high interest rates on government bonds because of the inherent risk compensation that needs to be included in those interest rates. Now, there is some wiggle room here. So a country like Bulgaria, they are going to adopt the euro in January 2026, assuming everything continues as expected. They managed to meet all of the criteria, except inflation was a little bit higher than what would be considered perfectly meeting that criteria. But as I've come to learn, the Maastricht criteria, you don't have to follow it perfectly, but you have to get pretty close. Some countries also, even though they don't use the euro, they are connected to it very closely. So, for example, Denmark is part of the European Union, but doesn't use the euro. But even though they don't use the euro, their currency is connected very closely to the euro. So what that means is the exchange rate from the Danish currency to the euro is roughly the same through time. Prior to the launch of the euro, there was this period where a European currency unit was implemented, an ECU. The idea here was to create a type of currency that wasn't really a currency just yet. Effectively, it was a creation of stabilized interest rates among those countries that were adopting the euro. So, for example, Italy, Germany, two countries that were heavily involved in this process prior to the adoption of the European currency unit, you would see these free flowing exchange rates. So, one day German marks may go up in value, the next day they may go down in value. The creation of the European currency unit meant that on a day to day basis, there was little to no change between the values of the Italian lira and the German marks. And this helped create a unit of account. If German marks had the same relative value to Italian lira on a day to day basis, it became really easy to know what the Italian currency was worth. And this helped create an established system where one currency's values and another country's currency's values stayed the same. Consider that a first step to the creation of a true European currency. The second major step occurred in January 1st of 1999 when the euro was introduced as a non-physical entity. So there was no cash euros or coin euros, but digitally transactions became expressed in euros. So what that means is if you set up a checking account at a bank, you would have your currency valuations expressed both as euro amounts and in your domestic currencies. So, for example, if you're in Germany and you open up a checking account, you might have 1,000 German marks or 800 euros, and both of those values would be expressed to you. Likewise, exchange rates between countries were fixed, and again, based on the euro, that's how we determine these exchange rates. If you went and you bought stocks, those stock trades were expressed in euros. Think of this as easing into a system. You can't just suddenly adopt an entirely new financial system. You got to work out some of the kinks. And this process, which lasted about 3 years, where we had no physical euros, but we did have these non physical trades being made, allowed for the full adoption to happen a lot smoother. And full adoption began January 1st, 2002, so about 23 years ago. With the full adoption, physical money was now created by the European Central Bank. They decided how much money would exist, but the national central banks of those member countries continued to have the ability to print euros. It was like we're working as a team now. So the European Central Bank would say, we need to add, $10 billion of euros to the system, and then they would task certain countries with that job. Was seriously a massive undertaking. About 65 billion pieces of currency were released at the onset. And I'm not saying 65 billion euros, I'm saying 65 billion physical pieces of currency were created at the beginning of the euro. Within 2 months, euro notes and coins fully replaced domestic currency, so that transition period ended. And now all of these countries that were in that initial group adopted the euro and it was used as their currencies. Now, there were definitely some growing pains. Some people viewed the euro as an excuse for greedy businessmen to raise prices. Most notably in France, there was concerns that bread prices went up. If you look at the currency exchange rates, for example, you would see that in the domestic currency, let's use Germany as an example, bread maybe needed to be 1 mark. And after changing over and using the euros, if the currency had exchanged unilaterally, the price of bread would have gone from, say, 1 mark to 0.8 euros. But after the exchange, the price of bread actually rose to 1 euro. So it got relatively more expensive. And this did seem to happen in some places from everyday purchases, things like gas and bread, wine, coffee, things like that. It seemed like businesses took this chance as an opportunity to raise prices a little bit. Basically, businesses would raise prices to the nearest whole unit, and they would do that by raising prices up, not down. There were also some cash shortages. There are examples of countries where they just ran out of euros. So imagine going to the ATM, trying to get some money out, and there was simply not enough euros to go around. Now, there's plenty of digital currency because digital currency had been used for a few years, but the physical currency was lacking. And so the European Central Bank had to catch up to these shortfalls. There were also small increase in currency-related crimes as the new currency was created. You had criminals trying to exchange counterfeit money in. If you're in Germany, counterfeited German marks were exchanged into euros, and that was sometimes hard to catch. And also, just in general, there was a lot of political uncertainty here. A lot of people didn't like the euro. From what I read online, a lot of older people really didn't like the change to the euro because it was complicated. It was a new program. People at the very beginning of adoption, they would go to the grocery store and see two different prices in their domestic currency and prices in the euro. And then they would go back a week later and there was only prices of the euro. It was complicated and it was a lot for individuals to consider, especially those who were very accustomed to the old ways. Nevertheless, adoption did go through and it was pretty successful. Initially, there were 12 countries that adopted. You can see them listed there. Greece, a bit of an outlier because it was late to join the European Union. It missed out on a bit of that pre-planning period, but nonetheless, when the euro was adopted, it was one of those first countries. Since then, we've had a handful of countries join, and Bulgaria will join in 2026. And there may indeed be others. For example, Sweden has pledged to eventually join the euro, but it's really not made any significant efforts to do so in the last decade. And to show you the physical nature of the adoption, you can see the countries listed there in blue. Those have all adopted. So you can see it's a big portion of Europe, but you can see it's also somewhat scattered. And a real obvious, interesting case there is Switzerland, right there in the middle of the Eurozone. Seems like that'd be a good country to visit if you wanted to figure out what it looks like to use the euro versus what it looks like to not choose to join the euro. So Switzerland, a real outlier. If I was visiting Germany and wanting to learn about currencies, that'd be a good place to go. Pros and cons. Let's think about what's good about the euro, what's bad about the euro, and ultimately, has it benefited or hurt those countries that chose to adopt? The first, really most obvious benefit of adopting the euro is the reduced transaction costs. Now, in the first video of this series, we discussed transaction costs, so I'm going to hope that you understand them pretty well already. But just in case you discover this video secondhand, transaction costs are the costs that are associated with transacting a good, but not producing that good. So, for example, if we think about beer, the transaction costs are everything other than brewing the beer. So that would be marketing efforts, maybe doing currency exchange, transporting that good from one place to another, etc. An obvious benefit of the euro is that it reduces the cost of transactions. For example, if I live in Germany and I'm going to go on a trip over to France, I don't have to worry about currency exchange. I don't have to worry about thinking what prices are going to look like in that new country, or I don't have to worry about the added little cost that comes from exchanging money because there's always fees that come with exchanging money. All of that is thrown out. It's just like being in the United States. If you go from Georgia to Alabama, you don't have to worry about different currencies or anything, and it just makes things very, very much easier. What we would expect is this would have positive effects on trade, and as you will be tasked in the quiz, you should be able to guess what effects this would have on real exchange rates. Second, more complicated effect of unilateral currency is that it eliminates exchange rate risks, okay? So to try to explain exchange rate risk here, let me give you this little example that will hit home for a U.S. citizen. Let's say that I'm thinking about moving up north, either to Michigan or Toronto. Okay, now obviously Michigan's in the United States, Toronto is in Canada. Right now, a house in Michigan costs $600,000, and that's U.S. currency. Also, I could buy a house in Canada for 831,000 Canadian dollars. Now, I chose those values on purpose. In terms of real exchange rate, those are the same price. All right, a $600,000 U.S. house has the same cost as an $831,000 Canadian dollar house in Toronto. However, let's think about timing here. I'm going to buy that house in 6 weeks. Here's the problem. If I'm a U.S. citizen, I'm going to buy a house in Toronto in 6 weeks. If currency exchange rates change, the actual price for me buying that house could fluctuate dramatically, okay? If, for example, if the Canadian dollar gains value over the next 6 weeks, that means it's going to be more expensive for me to buy that house in Toronto. However, buying that house in Michigan, that's in US dollars for me. There is no exchange rate risk because I don't have to do any exchanging. So if I'm not really sure where I would want to buy the house, I'd lean towards Michigan because it's less risky. So if I'm going to try to define it here, exchange rate risk is the risk that currency values will fluctuate in an unfavorable way before a transaction. Now, to be clear, risk isn't all bad. In this example here, if I commit to buying the house in Toronto, it's possible that the US dollar could appreciate prior to the transaction, and that would make the real cost of that house cheaper for me in 6 weeks. But when it comes to risk, most people are scared away about risk. They focus more on the potential downside than they do on the potential upside. In other words, most people are risk averse. They would prefer a sure thing to a risk. So exchange rate risk will cause people to engage in fewer transactions because they're afraid of the potential downside. So if there's something that can eliminate or reduce exchange rate risk, that would help out. And indeed, that's what the adoption of the euro does. If you're somebody in Germany that is thinking about buying something from somebody in Greece, there was massive exchange rate risk prior to the adoption of the euro. But after the adoption of the euro, there isn't any. There is no exchange rate risk because you're on the same currency system. To illustrate an extreme example of exchange rate risk, let's look at the US dollar here versus Mexican pesos. And you can see here, there's a decent amount of volatility through time, but there's a couple of times where the currencies really change dramatically in values. Most obviously there towards the end of 2019. What happened there towards the end of 2019 is Donald Trump was surprisingly elected president of the United States. And as a direct result, the US currency gained value or appreciated relative to the Mexican peso. And it was pretty much overnight. Immediately after those election results were known, the Mexican peso lost tremendous value relative to the US currency. Think about what that would do, right? If you're thinking about making a big business deal with somebody in Mexico, you would be terrified that some drastic change in currency values could make your deal a bad deal. So when currency valuations are jumping around, when there's high volatility in exchange rate markets, that causes people to clam up and not want to make business deals, and that ultimately reduces economic activity. And to see a more current example of this, this is the euro relative to the Swiss franc. And you can see, even though it's not quite as volatile as the US dollars to pesos, there is nonetheless volatility, okay? So if you're a citizen in the Eurozone and you're making a big business deal, you would prefer to make a big business deal with another country that's in the Eurozone relative to somebody that's in Switzerland. Because if you're engaging in talks with somebody in Switzerland, there's an inherent exchange risk that comes with that. So as a result, we would expect that trade between the Eurozone countries would be enhanced after the euro and be reduced for countries that are outside the Eurozone. And indeed, that appears to be what happened. As a third direct benefit of the adoption of the euro, there's improved price transparency or an enhanced unit of account. And we made a bit of a mention of this earlier, but remember, unit of account is how you value things, okay? So for example, if me and my family goes on a trip to Hawaii, Hawaii is really far away. It's very different culturally, but the currency is the same. So if I get to Hawaii and I go out to eat and I see that a meal costs me $22, I don't have to think to myself, what is $22? What is that really worth? I understand what a dollar is worth intrinsically because I am so accustomed to making transactions in US dollars. Similarly, to countries that are in the Eurozone that have adopted the euro, the price is much more understood. So for example, if you're doing a trade pre-euro, you might be traveling to Germany and try to figure out, well, if something costs me 110 marks, what does that really mean? Is that expensive or cheap? You'd have to do some math in your head to figure out what's a good deal and what's a bad deal. Nowadays, if you're traveling from Italy to Germany, the prices are expressed in euros. It just makes things easier. And that ease can cause people to make more transactions. Okay. If that doesn't make sense to you, imagine you're thinking about traveling. And I'm going to tell you, you can either travel to the state of Washington or you can travel to Vancouver, Canada. Now, Seattle, Washington versus Vancouver, in terms of location, they're very similar. In terms of geography, they're very close together. In terms of climate, they're very similar. But wouldn't you agree that going to Vancouver is just more difficult because they have a different currency? I think so, right? So anytime you're traveling to a country that uses a different currency, that creates a bit of a barrier to entry, which reduces the amount of economic trade that happens between those two nations. And this is particularly true when you think about really large business transactions, right? If I'm a country, if I'm located in Germany, it's simply easier for me to make deals with somebody in France than it is with somebody in Switzerland because I don't have to think about currency exchange. A fourth benefit, one that is particularly important for countries that are a little bit less economically stable, the adoption of the euro creates credibility. So if we think about a country like Bulgaria, Bulgaria it's definitely not a third world country or anything like that, but it is less economically stable and less economically developed than, say, Germany, Switzerland, France, etc. Once Bulgaria joins the Eurozone and adopts the euro, it is now a member of the European Central Bank. It is now connected to these countries that are very stable, and that would create more stability, or at least a better view of the country's stability from outsiders. So if I'm, for example, thinking about lending money to the Bulgarian government, I might think that it's a little bit safer after adoption because these other countries kind of have their back. And this actually was pretty evident with both Greece and Portugal, which are a little bit less economically stable than other members of countries that have adopted the euro. Greece, their interest rates for the domestic government there, interest rates went down after the adoption of euro because investors basically figured the Greek government was less risky after adoption. It had some interesting consequences, as we'll learn later on, but that credibility definitely is a benefit for those countries that desperately need it. The fifth benefit, there are reduced inflation and interest rate risks. And we're going to discuss this a little bit more here in just a bit, so this should become more clear. And hopefully this is something you've also learned in other classes, but let me go over it very, very quickly here. As I mentioned before, most investors are risk averse. What that basically means is, if let's say I offered you either $10 or a 50-50 chance at $5 or $15. Now, both of those potential gains there or potential options have the same expected value, right? If I'm saying there's a 50% chance of 5 or 50% chance of $15, the expected gain, the expected amount of money you get there is $10. But most people would choose this sure thing because they would prefer a safe outcome to a risky outcome, even if the safe and risky outcome have the same potential value, right? Interest rate and inflation rate risk are basically the manifestation of that, okay? Regarding interest rate risk, if you are uncertain if interest rates are going to go up or go down, that might make you less likely to make a deal. Similar to that, if you think inflation rates could go way up or go way down, even if you're not sure which of those is going to occur, it might cause you to make fewer transactions. And we'll explore that here in just a second. But if we think about the Eurozone, some of those countries, particularly those countries that are a little bit less economically stable, they have highly variable inflation and interest rates. And that tends to reduce economic activity because it causes citizens to be scared about making transactions. So one big benefit of joining the euro is that interest rates and inflation rates became relatively more stable after adoption. And to kind of think of the direct results of those benefits that we just discussed, reduced transaction costs, reduced risk, etc., the end result is the trade among the Eurozone countries increased. Hard to know exactly by how much, but experts say somewhere between 5 and 15% after adoption. Interestingly, though, it seems that benefit was mostly felt in the decade immediately after adoption, Nowadays, those gains, it's kind of harder to tell if there's really such a substantial gain anymore. There's also an argument that the adoption of the euro created strengthened political connections among those countries and ultimately might reduce the risk of any kind of war or conflict in the future. But there's really no way of knowing, right? There's no way to know what would happen if the euro had not been adopted. So really, both of these bullet points I show you here are ultimately hypothetical. With benefits also come costs, which is pretty much always the case. Some of the costs here is that once you adopt the euro, you lose the ability to do monetary policy. So again, focusing on Germany, I'm choosing Germany because we're going there on our study abroad trip, and also because Germany is such an economic powerhouse. Prior to the adoption of the euro, Germany and its central bank could really do whatever it wanted, right? If it wanted interest rates to go down, it could do that pretty easily by increasing the money supply. If it wanted to push inflation up, it could do that. But after the adoption of the euro, it no longer has the autonomy to make those types of changes, and that limits its ability to do monetary policies to stabilize the economy. Similarly, member countries' problems become yours, and we're going to see that with Greece here in a little bit. So if you're a country like Germany that's very, very economically stable, you might actually see things get less stable when you have economies like Germany become so integrated with yours. And to see that, we can think about three countries that chose not to adopt the euro directly: Denmark, Poland, and Sweden. All three of those countries have performed very well since the euro came to be, and they have not obviously adopted the euro. So it just goes to show that adoption of the euro is not something you have to do. It's not a prerequisite for economic success. And I think if you ask members of those economists in those countries, they might say that choosing not to adopt the euro has actually helped these countries become economically advanced. Now that we have a bit of a list of pros and cons for adopting the euro, let's dive in on some more specific topics here. First of which will be risk. Various forms of risk are affected by the adoption of the euro. We're going to explore those here right now. So the first thing we're going to discuss is inflation rates. Now you might think that if countries all have the same currency, they would all have the same inflation rates. And maybe that's how it feels in the United States, because inflation data always gets reported at the national level, right? So like inflation in the United States right now is about 2.5%. You'll rarely see anybody break that down and say, okay, well, what is inflation in Georgia? What's inflation in Maine? But truth be told, there are some small differences from state to state. And there are some pretty big differences country to country for those countries that have adopted the euro. So as an example of how this can happen, check out the middle bullet point there. Imagine there's really bad weather that destroys livestock and crops in Spain. Of course, if there are fewer crops available in Spain and there are fewer living animals for us to consume, that's going to make food more scarce and it's going to make it more expensive. So food prices in Spain would increase. That would cause inflation rates in general in Spain to be higher than they are in other countries. Now, that would bleed over into other countries. Okay, so if in Spain food is scarce, Spain is going to import food from other countries. But because of transaction costs, there will still be differences from place to place. So inflation rates in Spain would be higher than they would be in other countries in the European zone. Key drivers of these differences in inflations within those countries that have used the euro: changes in productivity and wages. So anything that affects economic growth can affect prices. Energy costs, a really big one there. So if energy costs go up in one country but not another, that can cause inflation rates to go up in a given country. Energy is an important one too because it's a little bit harder to transact, right? It's not like food that you can just drive across the borders. Sometimes energy costs are really hard to pass on from one country to another. The same being true with housing costs, right? If housing costs in Spain go way up, you can't just import housing from another country. So if housing costs in Spain go up, that's going to cause inflation in Spain, and that'll be mostly isolated. And fourth, governmental policies. Any kind of trade regulations or specific taxes in one country can cause prices to change in that country in a different way than they are in others. So interestingly, even though inflation rate risk is reduced because of the adoption of the euro. It is not eliminated. Inflation rates can be different in different countries, even if they have the same currency. Evidence of that, take a look at this graph right here, which shows 4 of the members of the Eurozone, along with the average inflation rates for the Eurozone. And what you can see here is inflation prior to 2021 or so is pretty linked among these countries. But in 2022, you get this massive surge in inflation, with Estonia reaching nearly 20% inflation rates. And this was driven largely by the war between Russia and Ukraine. Estonia really relies on trade relationships between both Estonia and Russia, and also Estonia and Ukraine. And when those trade negotiations were cut off or dramatically reduced, energy costs in particular went way up in Estonia. It also got harder to get food in Estonia. So even though Estonia has the same currency as, say, Spain, those countries are really far apart, and the types of economic events in Estonia can be very different than what's going on in Spain. And as a result, you get changes in inflation rates. Okay. Now, what's interesting about this is this has the ability to affect other countries in the Eurozone. So even though inflation rates were much lower in Germany, the economic events occurring in Estonia will ultimately affect currency rates and inflation in Germany. So if you are Germany, a country that is very economically advanced, the goings on in other Eurozone countries can have an externality effect on your own economic well-being, which could be seen as a negative. As we will soon see in the third video of this series, which is going to go in depth on the European Central Bank, the European Central Bank does have uniform interest rates for various forms of lending. For example, if a bank, just a regular commercial bank, wants to borrow from the European Central Bank, there are uniform interest rates. So if you're in Estonia or if you're in France, the interest rate for you would be the same. Again, if you are a commercial bank borrowing from the ECB. However, this does not mean that all interest rates are fixed on all forms of debt. So even though interest rates at the core level, those issued by the ECB, are the same for every country in the Eurozone, the interest rates on specific assets are not the same. As a result, just as there is inflation rate risk, right, uncertainty regarding inflation rates from country to country, there is also interest rate risk. Differences in interest rates across countries here in the Eurozone are indicated by this graph. 5 countries there selected. You can see that in Greece, loaning money to their government yields a much higher interest rate than loaning money to the German government. This is 10-year government bonds among these 5 countries here, and the differences are generally a result of a risk premium. Loaning money to the German government is risk-free, so that interest rate represents a risk-free loan of about 2.3% annually. Whereas if you loan money to the Greek government, there is risk there. There is a risk that they will not pay you back. So the difference there between the Greek government interest rates and the German interest rate is the risk premium. Okay? So as long as there's differences in risk premiums from country to country, there's no reason to think that interest rates will be the same from country to country. What's causing these differences in interest rates from place to place? Well, it's risk. It's different styles of risk. Now, the type of risk that people tend to think of when they generally think of risk is default risk. And that's the risk that the borrower will not pay you back, okay? So if I loan $100 to a friend and you ask me, is it risky? What I generally am thinking is there a chance that person doesn't pay me back? All right, that's default risk, the risk that they don't pay you back. But that's not the only form of risk that occurs. We've also learned about inflation risk. And that's the risk that inflation rates are going to go up or down in the future. Now, with all forms of risk can be good or risk can be bad, right? If you invest in the stock market, it's risky, but that includes the risk that things go really well, all right? But because we're risk averse, we tend to focus on the downside. So if somebody owes you money and inflation rates go up, that is bad for you, right? If a friend owes you $100 and they promise to pay you 1 year from now, the real value of that $100 is going to be lower if inflation rates go up. So if inflation rate is jumping around a lot, that risk tends to make people less likely to invest in bonds, for example. Similarly, there's interest rate risk. That's the risk that interest rates will change in the future. Okay, we talked about this already in this video. But as an investor, what I'm scared of is the possibility that I buy a bond, and then shortly after I buy a bond, interest rates go up, which would cause the value of my bonds to go down. Okay, now all of these forms of risk make me wary as an investor. So if I'm thinking about investing in the Greek government, for example, the Greek government has a higher default risk, a higher risk that they don't pay me back. But they also have a higher inflation risk and a higher interest rate risk because these things tend to be more volatile in Greece than they are in Italy, France, or Germany. If you're not accustomed to this idea of interest rate risk, let me take one step back and make sure that you understand how this works, okay? Let's imagine that the current interest rate on a bond is 10%. So I own a bond that will pay me $110 in 1 year. If interest rates are 10%, that means my bond is worth about $100 today. Likewise, any newly issued bonds that pay $110 in 1 year would cost $100 now, right? So the value of my bond is $100. Now that doesn't mean that I paid $100 for that bond. Maybe I bought that bond 29 years ago, and it's a 30-year bond with 1 year left on it, okay? I could have bought that bond a long time in the past. But the important thing to recognize here is that the current price of that bond is a direct result of what interest rates are in my local economy. If interest rates go up to 20%, that means that any newly issued bonds are going to be issued with a lower price today. Now, I'm fudging the numbers here a little bit because I'm not so worried about the math, but let's imagine you're a business that is trying to borrow money now. If you're planning to pay people out $110 1 year from now, you're going to be able to borrow $90 now. Now, my bond that's going to pay me $100 in 1 year is now worth less than it was before. If interest rates go up, the value of my bond will go down. Now, if you're seeing this for the very first time and you need additional resources to really get this hit home, reach out to me and I can send you some. But this is such a well-known concept in finance. If you do a little bit of Googling, you can do a lot of self-guided learning with no problem at all. But please, don't hesitate to reach out if this is not clear. I know a lot of people in this class have seen this multiple times, so I don't want to waste their time. But if you need information, let me know. As stated before, there's an inherent correlation in these risks, right? So in a country like Greece that has very high interest rates right now relative to countries like Germany that has basically no risk, Greece has a higher default risk, a higher risk they don't pay you back. They have higher inflation risk because things are generally more unstable in Greece. And likewise, they have a higher interest rate risk because interest rates in Greece jump around a lot. And certainly they do for the federal government, right? Interest rates in Greece can go way up or they can go way down depending on what the current level of risk is. In Germany, they tend to be a lot more stable. So all of this instability that occurs in a country like Greece means that interest rates are going to be higher than they would be if there weren't forms of instability. And this is true even if you take the default risk out of the picture. Even if you take default risk out, interest rates would still be higher in Greece because investors are scared of the inflation and an interest rate risk that occur for any Greek investments. What we tend to believe is that the adoption of the euro did reduce risk for these countries as a whole. Okay, so what I mean by that is if you aggregate the 20 countries that have adopted the euro, those countries have lower levels of risk today than they would have had if they hadn't adopted the euro. But it's probably different on a country by country basis. Germany, which is probably the most economically stable country within the Eurozone, certainly among those that are very economically important on the global scale, right? Germany, it probably didn't have that major impact on risk as it did compared to a country like Estonia, which has generally higher levels of risk. but we don't really know for sure because there's no counterfactual. Counterfactual is what would have happened instead. So if the euro had not happened, if the eurozone had not have been created and the euro had not have been adopted, we don't know what levels of risk would have looked like. So it's really all guesswork. But if you ask economists, they generally believe that risk levels are lower now because of the euro. And that is good news for those countries that have adopted. So now that we've talked about risk, let's move on to the second key topic related to the euro, and that is currency manipulations. A very famous form of currency manipulation happened between the United States and China starting in the 1990s, arguably even earlier than that. And some people would say it's still going on today, but it's a little bit harder to know if it's happening today because China is not as obvious with any kind of currency manipulation if it is engaging in those today. Now, when I say currency manipulation, that could be anything, right? That could be trying to make your currency jump around in value. That could be trying to make your currency worth as much as possible. But when we see forms of currency manipulation in the wild, it's usually countries trying to make their currency worth as little as possible. So in the 1990s, China made its currency worth very little. They basically manipulated the market to make Chinese currency cheap, especially for US citizens. So if I'm a US consumer, it becomes really easy to get Chinese currency. Chinese currency ends up looking really cheap. And since it's really easy to get Chinese currency, it's also really easy to get Chinese goods because I can take 100 US dollars, exchange it for Chinese currency, and then buy Chinese goods. And I can get a lot more goods in China with my initial $100 than I could have in the United States. Effectively, it's a manipulation of the real exchange rate. As an end result of this, in the US, we bought lots of Chinese goods in the 90s. And as a direct result as well, people in China bought relatively few US goods. So we bought a lot of their goods. They bought not as many of our goods. And as a result, we get this massive trade deficit, which had a lot of lasting impacts on the US and Chinese economies. Now, it's not all bad. I think when people see this, they tend to think, China is screwing us over or something. I don't really see it that way. I mean, they're selling stuff to us really cheaply. And I would argue that we benefit from that. All right. I think it's a bad policy on their part, but I would say that we generally benefit from that. To put a metaphor on that, imagine if Blackbird Coffee in downtown just started selling you coffees for really cheap. Would you complain about that? Probably not, right? But it definitely does have impacts on the economy, and some of those impacts can be negative, right? There's other examples of manipulation of currencies, which I might ask you to explore in the quiz. In Italy with Mussolini, the Battle of the Lira, really famous example. Switzerland has allegedly been up to some currency manipulation, which we're going to explore in quiz 4. But the importance of currency manipulation in the current video that we're discussing now is once you adopt a currency like the euro, it ends, right? You are now connected to all of the other countries that are using the euro. So if you are Spain and you want to manipulate your currency to devalue it, you don't have that authority anymore. The European Central Bank is the only authority for changing the value of the currency. So any of these types of manipulations that you might do when you are an independent country, you lose that ability to do, for better or for worse, after the adoption of the euro. And as really a final step in this video, I want to discuss a major European zone crisis that occurred right around 2008, 2009, which a lot of people call either the Greek debt crisis, or if you're in Europe, you might just call it the crisis. That's how big of a deal it was. Let's go through the steps here a little bit. Greece was one of those countries that was in the initial group that adopted the full-on version of the euro, but they were a little bit late to joining the Eurozone in general, and so they perhaps were a little bit less prepared to handle the ramifications of adopting the euro. And furthermore, the Greek government and Greece in general is a little bit more economically unstable than most of the other members of the Eurozone. So there was a much bigger impact on Greece than there was on other countries. Specifically, when they adopted the euro, that gave Greece credibility in financial markets that they didn't have before. So, for example, in the United States, as an investor, I might have been unwilling to buy Greek government bonds prior to the adoption of the euro. But after the euro was adopted and created, I might think, look, I don't necessarily trust Greece so much, but I trust these other countries that now Greece is directly connected to. I trust the European Central Bank, so I'm willing to invest in Greek government bonds because I figure, the ECB will bail out the Greek government if there's any default risk. So as a direct result, interest rates went down, and the Greek government took advantage of that by increasing its borrowing substantially. It increased its government debt, it increased its debt, and from a lot of accounts, it appears it had underreported these for years. Remember that criterion we talked about before, that in order to join the euro, countries needed to maintain relatively low levels of government debt. It's possible that Greece was actually underreporting its debt so that it could adopt the euro, or after adoption, it went crazy with borrowing because it didn't have to fulfill those requirements anymore. It wasn't worried about getting kicked off the euro once it joined. The bottom line is, as it borrowed more money, this directly coincided with a trade deficit. And this is a bit of a rule in economics and finance, which is, if you have a trade deficit, you also are going to have a financial account surplus. Let's think about why that's the case, okay? Trade deficit means you're importing more than you are exporting. So you are buying more goods than you are selling. Think about what that would feel like at the individual level, right? Let's imagine that I create income by selling stuff, and I spend my income by buying stuff. Well, if I'm spending $100,000 every year, but I'm only producing $80,000 worth of goods every year, that would be a $20,000 trade deficit. And where am I getting that $20,000 from? Well, I must be borrowing it. The same is true for countries, right? If a country is importing more than it's exporting, that basically means it's consuming more than it's producing, and therefore it must be borrowing. So there's a lot of moving parts here. It's kind of hard to tell which is causing the other, but the bottom line is Greece had a trade deficit, and it also had a financial account surplus, and these two things were going hand in hand. What was probably causing this to get really out of hand leading up to 2009 is, again, those low interest rates. People suddenly had an enhanced trust in loaning money to Greece, and they took advantage of that by borrowing as much as they could. That created a trade deficit. It created a financial account surplus. And in 2009, as a result of the global financial crisis, all of this began to dry up. Everything was going okay-ish up until this point. But as you probably know, 2008, 2009, we had this massive worldwide recession. And the Greek government, which had been borrowing and borrowing and borrowing from years, suddenly didn't have anybody to borrow from. Nobody was lending. And not being able to borrow money became a big problem. Now, in a world where there is no euro, where Greece has total autonomy over its currency, what it would probably do to try to fix this issue is create more currency, okay? If Greece creates more currency, one thing that will do is devalue its currency, like we just talked about before. When a country devalues its currency, it will export more goods, it will import fewer goods, and that will help reduce that trade deficit. At the same time period, it will also reduce the foreign account surplus, okay? So if a country wants to reduce its trade deficit, it can devalue its currency. Greece may have done that if it hadn't adopted the euro, but as a member of the euro, it doesn't have that autonomy anymore. So it was harder for it to get out of this crisis. Furthermore, if Greece had been able to produce more currency, its currency would have lost value, and that would have made it easier for the country to repay its debts. Remember, when inflation goes up, the real cost of paying debt goes down. So by devaluing its currency, that would have not only made it easier to reduce the trade deficit and help fix some of these problems in its current debt situation, it also would have reduced the real cost of repaying those loans. But it didn't have any way to do that because it was using the euro. Furthermore, increasing the money supply would have had a third big benefit. It would have allowed Greece to create an economic stimulus. When money supply goes up, that creates short-term growth in economic behavior. But again, it didn't have that authority. It didn't have the ability to do that. think about the situation that Greece is in. Remember, this is around 2009. Greece has no control over its monetary situation because it doesn't have full autonomy over the euro, of course. Its economy is in staggeringly bad shape, and also the Greek government has been funding its purchases through borrowing, but nobody wants to lend money to Greece anymore. So here's the situation. It has no ability to do monetary policy. It also has no ability to engage in fiscal policy. Fiscal policy is governmental changes to try to stimulate the economy. So cutting taxes or raising government spending, it can't do that because its government has ran out of money and it can't borrow anymore because nobody trusts it. Ultimately, to try to fix this problem, the ECB, the European Central Bank, and other entities required Greece to commit to austerity, promised that they would stop spending money they don't have. Now, that's probably good in the long run, but it again doesn't really help in the short run because Greece it needed some way to get itself out of this problem, and it really didn't have a way. If that doesn't make sense, let's think about what the U.S. government did during COVID, right? The U.S. government sent out stimulus checks. It increased tax credits to allow people to have more money. It engaged in these government stimulus projects where it hired people to work for the federal government. All at the same time, the Federal Reserve, our central bank, drastically increased the money supply and cut interest rates. All of these things helped us weather the COVID outbreak from an economic standpoint. Greece had no ability to do any of this. So what that meant is a recession really turned into a full-on depression. Wages fell dramatically. Unemployment rates reached 25%. That means that 1/4 of everyone trying to work couldn't find a job. GDP dropped by 1/4. That is absolutely massive, really unprecedented. There is no other example in my lifetime of a developed country going into such substantial collapse that wasn't involved in any kind of war. Ultimately, the Greek government only had to pay about half of its funds that it promised to its lenders, and that hurt anybody that had been loaning money to the Greek government. And because because wages were going down, Greece ended up in this weird situation where it was experiencing deflation, even when the rest of the Eurozone wasn't. It was a real bad time in Greece. So as a legacy, thinking about how we would view the euro, we could argue that the unification of the Eurozone really attributed to this economic collapse. But I would caution you to consider really two factors here. One, maybe Greece would have had a collapse like this with or without the euro. And secondly, I would argue that Greece, which was really hiding how much its government debt was, by doing so, really made things worse for itself. So I don't know. Can we blame the euro for Greece's collapse? It's hard to say so, but we might argue that it wouldn't have happened without the adoption. It's an interesting case. To show how untrusted Greece's government was during this economic collapse, you can see that interest rates on 10-year government bonds to Greece rose well over 100% as this crisis was unfolding. And you can see, I mentioned 2009 is when this started. You can see how long it lasted. And really, Greece has not fully recovered from this, and you could argue that they never will. I mean, just look at the real GDP for Greece. Real GDP measures the inflation-adjusted amount of goods and services that are produced in Greece, and you can see in 2008, as that GDP started to go down and this crisis began to unfold, real GDP dropped precipitously from 2008 to 2012, and it is still well below its original levels today. So this has had quite an impact on Greece, and Greece has not recovered, and maybe they never will. But the impacts are not just on Greece. Once you adopt the euro, it's kind of like marrying into a family. When you marry into a family, your in-laws' problems, they kind of become your problems too. So for Greece, things were terrible, but Germany also felt some ill effects of this, more so than they would have if they had not adopted the euro. Germany was a key player before this crisis. They had a lot of exports to Greece. They invested a lot in Greece. And so Germany felt the direct impacts on Greece. Now, remember what we said before, that the adoption of the euro increased trade within the Eurozone by 5 to 15%. So that meant that Germany was trading a lot more than Greece than it would have if it had not adopted the euro. Germany, as the key economic powerhouse within the Eurozone, really felt an obligation to step in, and they used taxpayer money to aid Greece, and this created significant political strife within Germany, ultimately leading to this really large group of, I don't know if you can call them radicals, but a large group of people that think that Germany should move out of the Eurozone, that Germany should go back to having its own currency. It also strained relationships. Germany kind of feels like Greece owes it something now. And this is kind of what you get, when you're Germany and you're the big economic powerhouse in the Eurozone, problems within the Eurozone ultimately feel like your problems as well. And that's for better or for worse. It gives Germany a lot of power, but also a lot of responsibility, and a lot of those responsibilities fall as direct expense on the German people. On the contrary, let's compare that to Switzerland, which is that country that's isolated and didn't adopt the euro. As a result of the fact that it did not adopt the euro, there was a much smaller connection between the Swiss banks and Greece. So German banks were hit really hard by this crisis. Swiss banks not as much, because the Swiss financial system not closely connected to Greece. Actually, Switzerland had its own unique set of problems that are a result of this crisis, really very different from what happened to Germany. As a result of this crisis, investors that were looking for safety didn't really want to put their money in euros anymore. They wanted something that was disconnected from this crisis. So a lot of investors began putting money into Swiss assets, which included just directly accumulating Swiss francs. As people began to accumulate Swiss francs, the Swiss franc began to gain value. It appreciated in value. And as we've learned, when a country's currency loses value, it tends to export more. Conversely, if a currency's value increases, it tends to export less. So everything in Switzerland started to feel expensive to outsiders. So Swiss businesses that relied on exports did less of it. Switzerland also relies on tourism, but for outsiders, everything in Switzerland felt expensive because Swiss francs were so valuable. So as a result of the crisis, Switzerland imported more goods because other currencies felt cheap, but they exported fewer goods because Swiss francs felt expensive. To try to combat this, the Swiss National Bank created a euro franc floor to stop additional appreciation. Basically, they created their own form of devalued currency, which is something you can only get away with if you have currency of your own. So you can kind of see some of the pros and cons here, right? Some of the benefits of having the euro is that there's more trade within those countries, reduced transaction costs, etc. But some of the downsides are, if you're Germany, any kind of economic crisis within the Eurozone is going to affect you. On the other side of things, Switzerland had its own negative ill effects of the crisis. Not as large as what was felt in Germany, but it did have some ill effects. But it was able to get out of them a little bit quicker because it could manipulate its currency, which is something that Greece couldn't do, and that's something that Germany wouldn't be able to do either. Without question, the Eurozone is very important politically and economically, and the euro itself is very important. The euro is the second most traded asset in the world behind the US dollar, and with countries like Poland, Czechia, Hungary, Romania, and Sweden either planning to join or at least saying they're going to join, it stands to reason that the euro will become more important through time. That's the end of the video today. I hope you enjoyed it, and hopefully when we get over there to Europe, even though this wouldn't make you an expert having watched this hour-long presentation, it will give you a bit more insight so that you're more prepared to learn and more prepared to ask questions when we get over there. I hope you understand why we're choosing to visit Germany and why a country like Switzerland would also be really important to visit, because it has chosen not to adopt the euro, even though it is totally surrounded by countries that have. That takes us halfway through the online portion of this class. We'll see you in the third video.